Hello, friends. Wish you a very Merry Christmas in advance. Well, last week I said in my video very categorically that in spite of the fact that the indices were reporting overbought readings, particularly of the RSI, over which there was so much noise on social media, that the RSI was overbought and the markets would basically see a deep correction. And I debunked that theory. Sure enough, the markets shrugged off the overbought reading. It was the bank Nifty that saw a little bit of declines. And the second thing I pointed out to you was that the 21,450 levels on the Nifty 50 would be a threshold for the bulls to cross. It was only after this threshold is sustained on a sustained closing basis, then the up move would start. And 21,450 was overcome in the spot only on one trading sessions on a closing basis. So, is this short week ahead due to a holiday on Monday due to Christmas and coinciding with a monthly expiry of the December series, is the short week likely to favor bulls or is it likely to favor bears? In this video, let's examine based on the weight of statistical evidence. Now, coming up on your screen is the weekly market roundup window. And what you can see very clearly is that the decline was triggered by banking stocks because the bank Nifty fell twice as hard as the Nifty 50 in percentage terms. This, mind you, was in spite of the fact that the US dollar index was down 88 basis points, and that should have been a booster for emerging markets. But unfortunately, it wasn't. And what you saw is the weak dollar triggered buying in bullion. Gold and silver went up smartly as I had advocated last week. And oil and gas both went up because I had warned you that the concerted man-made shortages by Russia and Saudi Arabia by cutting output and trying to control and choke off the export market would see some amount of an uptick, at least till the Russian elections on 17th March 2024. There you have it. Oil and gas attempted to go higher. My long-term view still remains negative, but that's another story. The USD INR, which is the dollar versus the Indian rupee, rose 16 basis points. That means the rupee was marginally weaker. The 10-year benchmark bond yield went up 1 basis point. But overall, the pressure on bond yields remain. Friends, I do hope you've taken advantage of the 4 gilt funds that I recommended for you to buy on 14th of December. As I have been pointing out on our free Telegram channel, the contact coordinates come at the fag end of this video. On my free Telegram channel, I've been updating the scorecard of these 4 gilt funds, even though these are long-term investments, but I have showed you how, even on a day-to-day basis, on a week-on-week basis, you can make money even in debt funds, especially gilts. The NSE market capitalization lost a little less than 1/3%. That tells you that the profit taking was a little widespread. Market wide position limits fell, which is very natural ahead of expiry, and the US indices were uniformly higher, which provided tailwinds to our domestic markets. I now come to our in-house indicators, starting with the MWPL. Friends, the MWPL has actually come down in the third week of expiry of the November series. It's a little premature. Normally, the MWPL falls in the 4th week of a derivative cycle just ahead of expiry. But you have to adjust for the fact that the coming week, the expiry week, is shorter by one trading session. It's a calendar year-end Christmas time when FIIs are very thinly participating in the markets. So I would give bulls a benefit of the doubt and say that, hey, your exposure levels may be marginally lower, but I would rather wait for compelling evidence before thinking that you guys are tired. Let's now go to the index and stock futures turnover. Remember, these are 3 concurrent series, so that is December, January, and February. What you are seeing is that index futures turnover hit a period high on this 20-week time frame chart, and stock futures turnover also hit a 3 or 4 week high. That tells you that last week we saw brisk activity, which again is normal because you have expiry of the December series coming up, and traders tend to wind up their December contracts and go into January. So it results in dual turnover reporting. Let's keep an eye on the turnover, which obviously is going to be lower in the next week because of the holiday on 25th of December. Friends, I now come to the advanced decline ratio, which after the price is the most leading indicator of which way the winds are blowing. Now, the NSE lost less than what it lost in the prior week at 0.5%, but the advanced decline ratio rose higher to 1.47 as compared to prior week's 1.11. That means for every 100 falling shares last week, there were 147 gaining shares. This is an average of all 5 trading sessions last week. So risk appetite from one marshmallow traders or intraday traders was relatively higher, which is a positive sign. Friends, I now come to the Nifty and Bank Nifty prompt month futures basis analysis. Basis is nothing but the premium or discount prevalent in the futures market. It's basically a combined indicator of A, the risk appetite, and B, time left to expiry. As expiry approaches closer, you will see basis fall routinely, just like options premium. So you have 2 or 3 trading sessions left to expiry, which is why the basis has contracted. As long as the basis is still positive, which means futures are at a premium to spot and they don't go into discount, bulls are still in charge. Friends, I now come to our in-house indicator, the impetus, which you've trusted for almost 3 years in a row now. What you are seeing is that the Bank Nifty impetus fell more than the Nifty impetus, which lost a little, just a tad. But the fact remains that last week's declines were on poor impetus, which means there was no undue forceful selling coming in. So percentage-wise, you would have seen both the indices log losses, but actually speaking, the loss, the quality of the loss does not show that there was panic-driven short selling or heavy-duty unwinding. That is a saving grace. And in the coming week, being an expiry week, let's see how the impetus reading comes. Friends, I now come to our second in-house exclusive indicator you won't find anywhere on the internet, the lift, weight, thrust, drag indicator, or the LWTD indicator. Now, friends, last week I told you that the LWTD was at minus 0.48. That was the only warning that bulls would hesitate to provide proactive big ticket buying support. And I told you that the weekly LWTD being in the negative meant that short covering would boost prices, but it needs concerted fresh buying to continue to push markets higher. And the LWTD has taken a quantum jump to 0.33 from minus 0.48 in the prior week. That tells you that in the coming week, short covering should be fairly healthy. Not very surprising, it's an expiry week. Traders tend to roll over their longs more than they roll over their shorts. So will short covering revive prices and pull them higher? Hey, it's very much possible, but I would want sheer fresh buying support before I would go out there and become very, very gung-ho. But bulls still seem to have a fairly good chance of coming back. Friends, our in-house indicators are done. I now come to the market segment that's very close to my heart, which is the bond market, because the cost of money, coupon rates or interest rates are what make all the other asset classes in their markets go around. What we have seen is a 1 basis point rally in the Indian benchmark 10-year yields. That tells you that the precipitous drop in the yields of the prior week is getting marginally corrected. Now, like I mentioned, the 4 gilt funds that I had recommended are still in the positive, and the first tranche of investments that you made in these gilt funds based on my update on our free Telegram channel are still holding good. Even though these investments should not be looked at every hour or every day, I think you should basically be aware, which is why I've been posting updates. And whenever it's time to deploy the second, third, or fourth tranche into the gilt funds, remain assured you will get an update on our free Telegram channel. The contact coordinates of that come at the fag end of this video. Friends, the bond market's done. I now come to the Bank Nifty, which lost 1.35% on a week-on-week basis. It fell on 3 out of 5 trading sessions last week. And as you can see on the daily chart, I had warned you in the prior week that after a throw under below the Bank Nifty wedge formation, there was a very good chance that there would be a throw over. What's a throw over? It basically means that the Bank Nifty would go above the higher trend line of the Bank Nifty wedge formation, suffer a little bit of nervousness, and come down below that line. Now, why did I say that? Because empirical evidence monitoring throw under and throw over formation is, according to statistical data that we have in-house, fairly comparing in this matter. Now, the price is above its month-long moving average, which itself is turning higher, which tells you that the short-term outlook is positive for now. Watch the 46,370 levels as a near-term support. As long as the Bank Nifty is above this threshold, all is well, bulls are in charge, and you don't have to worry about anything at all. Friends, I now switch to the weekly chart, which is showing the bearish candle is contained in the prior week's bullish candle. That is called an inside formation. And how the price has fallen from the upper trend line of the wedge formation. The price still remains above the 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull, so the medium-term outlook is positive. The RSI. I had told you last week that the RSI may appear overbought, but in a bull market, RSI tends to be stuck in the overbought area for many days or even weeks. This is a daily chart again, and you are seeing the RSI at 65. Without getting into the specifics, I would say that our in-house statistical testing that we've done tells us that the RSI ideally should remain above the 66.66 reading, which basically would indicate that the bulls still have an upper hand. If the RSI was to stay below 66.66 and the price also starts sliding lower, it tells you that bulls may be losing momentum or their grip on the market. So do remember that on the daily chart, the Bank Nifty's RSI is below 66.66. Coming to the weekly chart, the weekly chart also has the RSI at 65 levels. So between the two, let's see which index appears to be, relatively speaking, weaker. In the week before last, this index was number 2 on the most volatile counters list as per our in-house statistical beta list that we maintain. It slipped 1 notch to number 3, not because the volatility in the Bank Nifty declined, but because volatility in the individual stock futures, relatively speaking, rose faster. Last week, I advocated estimated range between 49,425 on the upside and 47,000 on the downside. It touched a low of 46,920 and exceeded my lower estimated support by 80 points. 80 points. That's it. So it was basically less than a quarter of a percent. In the coming week, I would estimate a range between 48,675 on the upside and 46,300 on the downside. Friends, do watch our free daily, weekly, and monthly pivot levels on our free Telegram channel for intraday, swing, and buy and hold or sell and hold trades, respectively, in the options and futures segment. I have also recorded a video on how to use our pivot levels. It's more than what I think people know about or expect from pivots. It's not just a question of resistance 1, 2, 3 and support 1, 2, 3. There's a whole big story out there in how to use pivots. Do watch that video, please. Friends, the Bank Nifty done. I now come to the Nifty 50, which lost 0.5% and fell on 2 out of 5 trading sessions last week. And I advocated that the 21,450 level would be a near-term hurdle as per the Fibonacci studies that I had advocated, and you can see on the daily chart on your screen. What we did see was a close only on one trading session last week above the 21,150 level, and all the other 4 days the closing was below this threshold. The RSI I talked about, which must stay above 66.66 ideally to favor bulls, is at 72. That means the RSI of the Nifty 50 is, relatively speaking, far better than the Bank Nifty's RSI reading. As long as 66.66 or higher levels hold, bulls are still in control. Now the price is above the month-long moving average, which itself is turning higher, which means the short-term outlook is positive for now. A sustained trade above 21,450 level that I advocated last week will see short covering coupled with expiry related squaring up and may cause some more price rise. Friends, let's now move to the weekly chart on your screen, which shows a bullish hammer, which means the price fell on an intra-week basis only to recover at close of the week, and the price has settled in the upper half of the weekly range. However, the candle's body is contained within the previous week's candle, indicating consolidation. This is similar to what we saw on the Bank Nifty. Here, the weekly RSI is at 74. It's above 66.66. So the probability of a further up move still remains open. Remember, friends, the week is a short one due to a holiday on Christmas, and shorter weeks normally tend to favor bulls rather than bears. Now, what if the 21,450 level is overcome on a sustained closing basis? What is the upper target? Look at 261.8% Fibonacci ruler extension. It is close to 22,200 levels, which may be quite possible in the coming few weeks. Friends, in the week before last, this index was at number 11 on the most volatile counters list as per statistical beta rankings we maintain in-house. It slipped one notch to number 10. Not because the volatility has fallen on the indices, but the relative volatility in individual stocks has risen faster than the index. Last week, I estimated a range between 21,900 on the upside and 21,025 levels on the downside. However, the low it made was 20,977. So my low was exceeded by a mere 48 points. In the coming week, I estimate a range between 21,800 on the upside and 20,900 on the downside. Please do monitor the free daily, weekly, monthly pivots that we provide on our free Telegram channel for intraday, swing, and carryover trading in options and futures. Friends, now for the last bit of statistical analysis, wherein I present the derivative turnover constitution and contribution by all four traded instruments in the FNO space. We will basically check out the weekly chart on your screen where the index futures shown as a blue line see the contribution higher by 1 basis point, and where stock futures are concerned, shown as a red line, the contribution by the turnover is up by 5 basis points. Now, futures demand more margin, mark to market, extreme loss margin, and exposure margin, but the turnover was higher. Part of the reason, of course, could be due to the rollover. You tend to basically square up positions in the December series and initiate the next month's January series. So turnover is clocked twice. Now, the coming 2 weeks will see which way the winds are headed. In the option space, index options, which are basically the cheapest in terms of capital requirement options to trade, saw 11 basis points a higher turnover, which is shown as a army green line. Stock options, which are more volatile and demand a little higher in terms of capital, saw a decline in its contribution by 17 basis points, shown as a purple line. So net, I would say that risk appetite still remains healthy because futures segment turnover was higher, and we basically will see what's happening in the coming fortnight. I would have normally said coming week, but the week is shorter. It's an expiry week. So real trend determination and price discovery will take part only in the following week in January. Friends, now I share my trading strategy for the week ahead. First of all, I would trade light because the week is short and FII participation and even the domestic institutional participation for that matter may be smaller due to the holiday season. So bid and offer spreads are likely to be wider. Remember, I've made videos, I've posted so many updates on how to read your screen, especially the snap quote window and the bid and offer spreads, which are so important for any intraday or a swing trader to understand. Unfortunately for us, in the holiday season ahead, in the coming week, bid and offer spreads will really widen and they'll provide extreme amount of threat perception. So I would cut down my traded turnover. And last week, I remember telling you that oil marketing companies could possibly see a fall in their share price because oil prices were higher. That strategy paid off well as all three, HP, BP and IOC, fell. My focus has been on public sector units and especially public sector banks within PSUs since many months. I have recorded a special video on why I prefer trading public sector units. The hyperlink to that video is in the description and in the pinned comment below this video itself. Please do monitor that. So since public sector units are witnessing a big price ranges, why change a winning formula and try to rediscover the wheel? Let's stick to PSUs. In either direction, of course. Now, oil and gas rose as I was anticipating, and I have been advocating on a free Telegram channel in my strategy on oil and gas that Russian elections beginning on 17th March 2024 will see a concerted effort by the Russians, the Saudis, and the UAE oil exporters to try and give a boost to oil prices. But thereafter, US elections, which are slated for November 2024, will start to exert downward pressure on prices. So the calendar year 2024 is a fairly interesting and challenging one for energy traders. We have our cup of anticipation full, brimming over. Bullion, like I said, I expected to get bought into on dips, which happened. I expect the buying on dips to continue, especially if the US dollar index, the DXY, continues to fall. And if oil rallies again, oil marketing company shares may again see some amount of profit taking. Expiry and holidays will see volatility jump on very small turnover. And therefore, price discovery may be a little erratic. Your ingress and egress in trades, which is entry and exit, quick entry, quick exit, will be basically challenged in the week ahead. I conclude this video not before reminding you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. And in the comment segment, do let me know how my videos are helping you become a better trader. Hey, also please help us out by sharing our videos in your social media groups, in your friends and family, to help us reach out to smart traders like yourselves. Thank you for being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Do have a very, very profitable week ahead. Take care. Bye-bye.